These are three big tax mistakes that I see a lot of retirees make, and I don't want to see you make these mistakes. So let's go for a walk and let's talk about them. And the most important one is understanding the taxation of Social Security. That's a little more complex, so stick around to the end and we'll talk about it. The one that I want to start with is really for the first time in many of our lives, we have the chance to control our tax rate. Right? If you're working for a company, you have W-2 income, you have some ability on the margin to impact your tax rate, but not like when you're retired, not like when you no longer have W-2 income. You have a lot more control, and you want to use that control wisely. As they say in the Spider-Man movie, and I believe FDR was the first to actually publicly say it, with great power, the ability to control your tax rate, comes great responsibility. So I want to see you use this power and this ability to control wisely. So the first thing I want to call your attention to is just the power of these lower tax brackets. A lot of people don't realize that for long-term capital gains and for dividends, a married couple filing jointly can earn almost $90,000 in long-term capital gains or dividends. They can recognize those and pay and be in the 0% tax bracket for that area. So you want to use that wisely. And you want to, many of you may have heard of tax loss harvesting, when you have losses and you can recognize those losses and reduce your taxes. And yes, that's a powerful thing. Anybody at any age can use that. But when you can control your tax bracket, you really want to make sure that you're filling out those tax brackets. And so you can actually do something called tax gain harvesting, where you're taking advantage of the fact that a married couple filing jointly can make almost $90,000 a year. And you put on top of that the standard deduction, which for most of us, for a married filing jointly, is $27,700. But if you're 65 or older, a married couple can get an additional $3,000 on that standard deduction. So it's $30,700. So that's a fair amount of money. Let me get out of the way. There's a horse coming. That's a fair amount of money that you can make. So mistake number one is not thinking about and filling out the tax brackets that you have. Okay, the next mistake that I see people make is, the Roth IRAs and the Roth 401ks are a relatively new addition to the qualified savings account, the traditional IRAs, the traditional 401ks. So they're fairly new. And so a lot of folks my age have the majority of their money in a regular IRA or a regular 401k, the majority of their retirement savings. Not everybody, but thinking through, again, how much of the Roth that you want to convert. Now, one of the main incentives to converting to a Roth is the fact that at some point, if you're in a regular IRA, you're going to have required minimum distributions. At the end of 2022, the Tax Cuts Act 2.0 changed the RMDs for a lot of folks. If you weren't paying RMDs already, for a lot of folks, not everybody, but that's going to go to 75. So it's not as big of an impact as it used to be, because it used to be at 70 and a half. The year that you turned 70 and a half, you had to start taking required minimum distribution. So it's not as big of an impact, but you still want to be cognizant that if you have your money in a regular IRA or regular 401k, it might make sense for you to convert to a Roth IRA over time. You don't want to do it all at once. The way you want to think about it is you want to minimize your lifetime tax liability. And, right now, a lot of us feel, our tax rates are high. And depending on your vantage point, that may or may not be true relative to the rest of the world. But the question is, do you think the tax rate's going to be even higher in the future? With all the spending, with the deficit that the country has, with interest rates higher, I can see tax rates going up in the future, which makes the incentive for converting to a Roth even bigger. But again, you want to minimize your lifetime tax liability. And there's some assumptions that you have to make. What are future tax rates going to be? But factoring all that in, doing some conversion into a Roth, not all, but some, makes sense for the vast majority of us. Again, this is complicated, and so you want to speak to an accountant or a fee-only financial advisor to run the numbers for you and to see what's right for you. And if you thought that was complicated, the next one, which is super important, is a little more complicated. And that's the importance of understanding the taxation of Social Security. So with Social Security, if you make below a certain amount, and it's called provisional income, if your provisional income is below a certain level, which for married filing jointly is if it's below $32,000, and I'll put a link in the description where you can get information on what is provisional income, what's included on it. But below $32,000 of provisional income, which includes half of your Social Security payments. So the $32,000 includes half of your Social Security payments that you receive. So if a married couple, two people together, are, let's say, making $36,000 a year in Social Security, they would put $18,000 a year, half of that, into their calculation for provisional income. Let's see what else. Another gotcha with provisional income is you may have invested in tax-free municipal bonds where you're not paying tax on federal tax on your bonds. So in provisional income, they include what's called non-taxable income, which are these tax-free bonds essentially. Again, look for the link that I'm gonna put in the description as to what it is. But married filing jointly, up to $32,000 of provisional income with paying no taxes, $32,000 to $44,000, half of your Social Security is going to be taxed. And from $44,000 and above, 85% of your Social Security is going to be taxed. So again, it gets a little complicated. I think it's worth talking to an accountant or a fee-only financial advisor. But it's important to think about that you want to fill up these lower tax brackets, and you want to think about minimizing your lifetime income. And if you want to also see, how do other retirees compare to you? I want you to watch this video here, which talks about the average income of retirees. Thanks for watching. Bye-bye.